Sea Limited just reported their latest quarterly figures, and to be honest, a pretty good quarter. A little small miss here on EPS, but nothing that bad. Stock is down. Right now, at the time of making this video, it was down 6%, 3%. Now it's down 1% or so. But overall, the business itself, is it doing better? Yes. Is it becoming more profitable? Well, it's trending that way. Now, before jumping into the report, I do want to touch on something that came out yesterday, a report with regards to their take rate, with regards to their fees, commission. So it was reported that their commission now exceeds its rivals, with its fee in Thailand rising to as much as 13% in July from 10% previously. So the competition here is TikTok, Temu, and Lazada. TikTok charges as much as 8%, Lazada up to 10%. The commissions are also known as take rates and are levied as a percentage of a product sales of transaction price. The fee hike shows that Singapore-based Sea feels secure in its own efforts to become a crucial partner to merchants, helped by the e-commerce pioneers' broad user base and well-established delivery services. Yet the strategy is risky. Pinduoduo, Temu, and ByteDance TikTok have quickly gained users, and sellers could jump ship if they deem Sea's services too pricey. And that is something to consider from now on, right? If the platform itself is extremely sticky, then all those merchants will stay on the platform and not jump ship. But if they say, look, the fees are too high, we get the same results elsewhere, then we're going elsewhere and they will lose business. So it remains to be seen if the platform is truly sticky, yes or no. We'll probably see this in the coming quarters. Now, overall, this is how it looks like for Sea right now. Stock is basically flat, pre-market, has a market cap of $38.4 billion, a forward PE of 25.7 times. Yes, in the last 3 years, the stock is still down 77%, but actually if we look on the year-over-year performance, it's up 16%, and year-to-date, it's up 65%. Why is that? Well, because it did turn a corner. It did continue to grow, but grow in a profitable way, and that's exactly what the market wanted to see. So it got a reward here, up 65% year-to-date. Looking at the analyst expectations for the coming fiscal years, you've got sales growth of around 17, 14, and 11% or so until fiscal year 2026, but the bottom line EPS here is expected to grow much, much quicker. 147% year-over-year growth in fiscal year 24, then 94% and 46% year-over-year growth in the next 2 fiscal years respectively. The current average analyst price target sits at $79. That's up 18% from the price we're at today. And we already have one comment from an analyst. I will read that later in this video. And here you can visually see what has happened with the business in the last year or so. It's true that from a revenue standpoint, growth has not been exceptional, but we are seeing now growth reaccelerate. We are seeing free cash flow become, free cash flow positive. Return on invested capital, that's in the last 12 months, that's still a bit negative, but overall gross profit still green and growing, net income still green as well. So that's what the market wanted to see, and that's why it's now up 65% year to date. If we look at forward PE, EV to EBITDA, price to sales, price to free cash flow, and price earnings to growth, I mean, you can see it's now under the 5-year mean, but that's not that incredible, let's be honest, because previously it was extremely expensive. There was the pandemic bump where it went over $300 or so. So everything was quite expensive, plus an unprofitable period as well. So you've got here a bump in the 5-year mean. But all in all, for a business that is expected to grow okay-ish top line, but bottom line much faster, I think it's quite okay. And so before jumping into this quarter, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not. Would really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So let's start with some comments here. I'm happy to report that it has been a solid quarter for us, with our strong momentum from Q1 continuing into Q2. All 3 of our businesses have shown both strong growth and higher profitability. On Shopee's 2024 outlook, the CEO said, with the strong results delivered in the first half and our outlook for the rest of the year, we expect that Shopee will become adjusted EBITDA positive from the third quarter. We are also revising up our guidance for Shopee's 2024 full-year GMV growth to mid-20%. On the digital entertainment side, Garena delivered a strong quarter with more than 20% year-over-year growth in bookings, mainly contributed by Free Fire. On Free Fire, he said, I'm very, very proud to share that every single day throughout Q2, Free Fire had more than 100 million daily active players. This reinforces our conviction that Free Fire is an evergreen franchise. By the way, with regards to the full year GMV growth to mid 20%, it's great, but don't forget that last year was a year of basically negative growth or close to. Moving into the performance here. So e-commerce GAAP revenue that grew 33.7% year over year and 2.7% quarter over quarter. The digital financial services side up 39.5% year over year and 7.8% quarter over quarter. And digital entertainment's booking that's up 21%, 21.1% I should say, year over year and 4.8% quarter over quarter. Total gross profit was up 9.2% year over year to $1.6 billion. They also ended the quarter with $9 billion in cash equivalents, etc., etc. As for GMV for e-commerce here, that was $23.3 billion, an increase of 29.1% year over year. Looks very, very good. But last year, it was a quarter that, well, it decreased 5%. As for the e-commerce side of things, so Shopee, GAAP revenue and take rate. So the take rate here sits at 12.1%. So that continues to increase. That's very, very good. And of course, as we've seen, year-over-year performance is very well, a slight increase quarter over quarter. But the GAAP take rate is what you should be keeping an eye on, especially after the higher fees. As for adjusted EBITDA, we are basically close to being break even. Adjusted EBITDA as a percentage of GMV still at zero. Well, basically at zero here. Asia is the profitable part. Other markets, not so much. As for digital financial services or C-Money, it is growing quite nicely and NPL ratios are coming down. It's down slightly quarter over quarter. Moving to Garena, so digital entertainment side, we've got here quarterly paying user ratio. Yes, it's up year over year and we might have probably bottomed here at 7.5%, but we're down a little bit quarter over quarter, down from 8.2% to now 8.1%. But we have seen a nice rebound, especially quarter over quarter and year over year with regards to quarterly active users. As for average revenue per user, down year over year and down quarter over quarter. So of course, this is the monetization part of things. Keep that in mind. Now, all in all, for Garena, we've got bookings that are up, but revenue that is down year over year. Adjusted EBITDA is up, and year over year adjusted EBITDA as a percentage of booking, 56.4% compared to 54%. And as you well know, Garena digital entertainment side of the business is where, let's say, all the profitability comes from. But as they said, Shopee should start to contribute to that later this year. As for an analyst update here, we've got one from Jeffrey. So they say C reported Q2 2024 results with GAAP revenue beat expectations. By segment, Shopee GMV increased by 29% year over year versus their estimate of 26%, and segment adjusted EBITDA narrowed down losses to $9.2 million versus the estimates of $10 million. On a group basis, adjusted EBITDA came in at about $449 million versus their consensus numbers of $397 million. On Shopee's outlook, it expects adjusted EBITDA to be positive from the third quarter and revised up full year GMV growth to mid-20s from prior high teens. And they have a buy rating with a price target of $89, which is of course higher than the average analyst price target as of today. And so right now, looking at the graph, we did have last week, like many other stocks, a drop under the 200-day moving average, but we have a nice rebound. So that's great. Big green candle here. Currently, we are sitting at, well, just under the 50-day moving average. The 200-day one sits at $60.34 and the 20-day one at $65.35. So let's see if we can try and keep that candle above the 50-day moving average. It was, in my opinion, a good quarter, good comments. I mean, things are trending the right way. Now, it's only a time will tell, right? Can they continue to execute? Can they continue to grow and grow in a profitable way? Even with higher fees, is the take rate going to stay as high as today? Garena Free Fire, can they increase ARPU? Let's wait and see. Overall, I don't own the stock. You know why? I own Mercado Libre. I think it's just a better play. Plus, I also have Amazon, so there is that. But I can understand the folks that are still holding C Limited, because if it works out, then yes, of course, there's huge potential. But you have to keep your eye on certain metrics each and every quarter to see if they can continue to execute, to see if they can continue to grow in a sustainable way. So that's about it for me in this video. Do share your thoughts down in the comment section below. Like, subscribe, hit all the buttons, and I see you all in the next one. Bye-bye.